Today we're speaking with Chris Larsen, CEO of social lending firm Prosper. Social, or peer-to-peer lending, combines the technology of Web 2.0 with simple banking practices. Chris shares his thoughts on the benefits and challenges of this emerging financial market. Chris, for those who might not be familiar with it, can you explain social lending and how prevalent it might be right now?
Yeah, so the idea of social lending, kind of really piggybacks on, some of the things we see in microcredit in other countries, and really kind of harks back to the ideals of, kind of the early building and loan societies. The idea that, where does money for your small business come from? Well, it comes from your neighbors or from your fellow, community members, fellow Americans. Where are your savings? Well, they're in your neighbor's business that you visit every day. I mean, that's kind of the way things used to work in its sort of simplest form. And I think what technology is enabling us to do is to bring that back, kind of in a modern way. Social lending is all about, can you connect an individual who has money, who wants to make a decent return, and want to make sure that that money is put to good uses. Can you connect those people directly with the consumers, the small businesses that need, loans to do well in life or to start new businesses or create jobs?
So how much of the financial space is being used in this social lending way?
Well, I think the numbers are getting pretty respectable. I think there's estimates that, about $600 million in total industry-wide has been lent out through some kind of form of social lending over the last couple years. But clearly it's still in the scheme of financial services, still a nascent industry that's just starting. But I think one that has, gotten through the early growing pains and is really now establishing itself, as a good deal for lenders, and good for borrowers, that they can actually get more pro-consumer terms at better rates than they could with the banks, particularly given what's gone on in the banking world.
Now, I read a statistic from Gartner that says that by 2013, peer-to-peer lending, which I believe is the same as social lending, will soar, it says, to $5 billion of outstanding loans. Why do you think it's getting so much attention?
Yeah, I think that it is social lending, Prosper and the peer-to-peer lending space. I think it really is proving itself to be, a good source of credit formation, for borrowers and small businesses. It's becoming more and more well known. This is a place, where you can actually get credit and make pretty good returns from a lender. So both sides being pretty satisfied with the outcomes. I think fundamentally it's actually the economics here are fundamentally better than the traditional banking world, which is fairly inefficient. I think has obviously had a lot of problems and is one where people are just not able to participate directly in deciding who gets credit and at what price, which is what peer-to-peer really allows you to do. And I think that's even more important now with the credit crisis, which I think has really shown the banking industry, really given the banking industry a black eye. Not to say that it already did not have a black eye, but I think the level of frustration and anger, which I think is appropriate, I think has never been greater. And that is leading not only consumers, but I think the country to look at, okay, how can this be done in a different way that is more transparent, more fair, more participatory, and is going to lead to a better outcome for citizens, not just the people, on Wall Street that own these big institutions.
Yeah, that's a really good point. It seems like a lot of what's been going on with the banks is because consumers are losing trust in their banks, partly because of transparency and predatory lending types of things. How much of a role does the idea of trust and transparency play in the success of social lending?
Yeah, I think it's crucially important. I mean, the whole word, credit kind of comes to that, built on trust, and kind of basically means trust and credibility, and that's really kind of the heart of the whole industry. And I think Prosper and social lending, just like any other financial company, this is all about measuring and pricing risk appropriately. Instead of just this very small group of people dictating how it's going to be for Americans. This now kind of opens that up and says, it's now the people who get to decide. When it's people who are lending rather than institutions, they tend to intertwine the financial reward with the social benefit together. That's just something that I think is just inherently true about people and the way they think about things. Yeah, sure, people want to make money, but in the course of making money, they will stop and help somebody in need. And I think you can combine both of those in a way that's very constructive, much fairer, much more participatory, much more in line with maybe sort of democratic values than the sort of dictatorship values that the banking industry sort of comes from.
That direct connection definitely seems like one of the largest benefits of social lending. What other benefits might there be, either obvious or a little more indirect? And then also on the flip side, what are some of the challenges to the social lending market?
Yeah, I think another things about social lending as a banking system. Where is it going to be better? I think one of them is clearly this idea of some of the social data actually being a very important driver of risk and actually can change the behavior of borrowers. So, for example, a borrower has one of their friends who's providing even a little bit of the loan, so that friend of theirs has been invited by them to bid on their loan, even if most of the loan's coming from strangers. Just the presence of that one friend actually has about a 20 to 70% pickup in sort of the riskiness of that loan. Challenges, of course, are one, it's a new industry, and like all new industries, it has to find its way. These are the early years, and it's I think now we're reaching the second evolution of the industry, but certainly being vigilant in these marketplaces is critically as important.
Who are the customers of social lending market?
Yeah, so on the borrower side, the biggest use cases we see are people replacing credit card debt. So that's about 50% of the use case for borrowers, replacing bad credit card debt with peer-to-peer loans, which tend to be fixed rate, 3-year, fully amortizing installment loans with no prepayment penalties, very pro-consumer. You also see small businesses being about 20% of the use case, and these are really the micro businesses, not even small businesses. Sometimes can be with millions of dollars in revenue. These are really, the sole proprietors, 5-person, the nail shop, the restaurant. So true micro businesses. On the lender side, some of the interesting demographics we see, the average portfolio that people have as far as loans made is about $4,000. They tend to make about 100 individual loans to 100 different people. So average bid amounts of about $40 is what they're contributing to each borrower, which gives them a pretty nicely diversified group of loans. And interestingly enough, the lenders tend to be younger than the borrowers, which we were always surprised by. Maybe again speaking to the younger demographics tend to be the most comfortable with doing all kinds of things online, and probably lending money is pretty far down the adoption curve. And then the borrowers tending to be again older than those lenders.
Now that you've been working in the space, it's kind of been around a little while. Are there any lessons to be learned from the social lending industry that might be able to be applied to the traditional banking world?
Yeah, I think there are. So I think the right line for finance or peer-to-peer lending is one of maybe more libertarian paternalism, where yep, you want to have totally open markets, let people decide who they want to lend to and at what price, but you do have to have a healthy amount of information popping up at the right time. Hey, this looks like you're doing something dangerous. Either you're lending to somebody at too low a rate for the risk you're taking, or are you sure you want to do this? And still enable people to have the freedom, but with a healthy amount of paternalism when they're about to do something that might be dangerous. So, nope, peer-to-peer lending is really a third way of banking. You sort of have the Wall Street way of securitizing loans and mortgages, which has ended very badly, obviously. You have the kind of old traditional banks, get depositors. The whole idea of a traditional bank is paying my depositor, 1% for their money, convince them that their money's worth 1%, and then turn right around and convince their neighbor it's worth 19% on a credit card. You just can't have that in an internet world. So peer-to-peer is kind of a third way. I think that's the winning formula, because then it really has fundamental advantages to either the Wall Street banking system or the depository traditional banking system. It's a better model. It's more technologically efficient, and it has these special kind of behavioral characteristics that I think at the end of the day will prove to be a huge advantage.